Welcome to Book Summary. Dear friends, during the gold rush, why are central banks worldwide frantically buying gold? Dear friends, today, we will explore a phenomenon causing seismic shifts in the global financial market. Why are central banks from around the world rushing madly to buy gold? What is truly happening that turns the gold rush into reality? And what is the intimate relationship between gold and the economy? In this video, we will reveal the secrets behind the central bank's gold hoarding strategies and explain why gold has become the safest asset amid economic turmoil. You will gain a clearer understanding of why gold prices continue to hit record highs and factors such as the Fed's interest rates and credit crises that influence gold investment decisions. Importantly, should we buy gold now? Let's explore right away, but before diving into the content, please like, subscribe to our channel, and share to support us. Thank you very much. Recently, a significant economic event has occurred. The US dollar, along with other currencies worldwide, especially the price of gold, has reached a historic high, sometimes reaching $2,100 per ounce. Despite the international surge in gold prices, this has led to volatility in the gold market. You might have heard the saying that gold is a precious metal with commodity properties. Unlike ordinary commodities, gold has a crucial attribute. When its price surges sharply in a short period, it often signifies potential major global economic events, which may not be favorable news. Renowned American journalist Walter Cronkite recently published an article sharing his latest predictions. He believes that the Federal Reserve's interest rate hike cycle has ended, although many officials are hesitant to admit this. Chairman Jerome Powell has attempted to refute investor expectations that the Fed will cut interest rates in 2024, but the market remains skeptical. After a week, the price of gold has been pushed to a record high in the new millennium. Numerous records have been set amidst two major crises. Please note, this video does not offer any investment advice or recommendations for buying or selling. In 2024, a pivotal year for the world, especially for Wall Street, all expectations hinge on the Federal Reserve's interest rate hike cycle potentially nearing its end, leading to a rush into gold. Over the past 3 decades, the relationship between the Fed and gold has resembled a seesaw. When the Fed raises interest rates, the US dollar strengthens and gold prices fall. Conversely, when the Fed lowers rates, the US dollar weakens and gold prices rise. Thus, the US dollar and gold act like two sides of the same scale. When one side declines, the other rises. Remember back to 2020 when the COVID-19 pandemic emerged, causing extreme market turmoil globally and severely impacting economies. To control this situation and stimulate the economy, the Fed implemented quantitative easing, QE, an unlimited quantitative easing program, significantly weakening the US dollar and causing gold prices to soar. However, the massive money printing also led to high inflation, reducing the purchasing power of every currency, including the US dollar. Over the past 2 years, to combat severe inflation, the Fed has consistently raised interest rates. Recently, the United States has released some data indicating that inflation seems to have been controlled, meaning the initial objective of raising interest rates has been achieved. However, the nation's unemployment rate has reached its peak during this period. These signs have led Wall Street investors and experts to speculate that the interest rate hike cycle may have ended, and there is a high possibility that the Fed will begin to cut interest rates next year. This expectation has triggered a rush to buy gold, causing gold prices to rise. So, the question arises: will the Fed actually lower interest rates from now until the end of the year? To determine this, it is quite simple. We just need to consider 2 factors. If inflation remains high or economic indicators are good, the Fed may not quickly lower interest rates. However, if inflation is under control and economic indicators deteriorate, with a high unemployment rate, then the Fed is likely to cut interest rates. Many people may not understand why the expectation that the Fed will stop raising interest rates is emerging right now. But as I mentioned, the US dollar and gold have an inverse relationship. In theory, last year the Fed did not lower interest rates and even continued to raise them continuously. So why did gold prices start to rise last year contrary to the usual pattern with the US dollar? In the first half of 2023, the Federal Reserve continued to raise interest rates, yet whenever the price of gold declined, it rebounded. Why is this happening? The reason lies in the record levels of gold purchases by nations. Part of the explanation is the waning trust in the US dollar over the past 2 years due to various events, leading people to perceive the dollar as less reliable. Meanwhile, gold has maintained stable value. Even ordinary citizens across nations have been stockpiling gold. There are two main forces aggressively accumulating gold: individual investors and investment institutions, along with central banks. Individual investors alone cannot drive gold prices up to such heights. The entities truly capable of doing so are investment institutions and central banks of nations, the largest consumers of gold. In recent years, central banks worldwide have bolstered their gold reserves significantly. In 2022, global central banks' efforts in this regard reached a record high compared to the previous year. Gold reserves in the first 3 quarters of this year increased by an additional 14%. The People's Bank of China also ramped up its gold reserves to ensure forex reserve safety while reducing US bond holdings. Central banks acquire gold not for speculative profit but to leverage gold's risk-preventive properties. This strategy is understandable as global currencies are being overly issued. Over the past decade, the US dollar has increased 4.1 times, while the Japanese yen and euro have risen by approximately 3.2 to 3.3 times, not to mention the renminbi. With currency expansion, inflation drives up the prices of all commodities, forcing people to sell US bonds. For instance, the recent sharp decline in the yen occurred as the Fed hiked interest rates, causing Japanese products to become cheaper. Despite high US bond yields, the declining value of the dollar conversion exacerbates the challenging situation. So what should be done? Let's ignore the US dollar, because when the US dollar's interest rate rises, investors will move their money to the US, causing the value of Japanese assets to decrease, leading to a domestic cash shortage. When there is a lack of money, they are forced to sell US dollars to get cash. When everyone reduces holding US bonds and increases holding gold, confidence in the US dollar is no longer as before. Instead, it's in gold. The reduction in holding US bonds by countries is essentially to hedge against the risk of the US dollar depreciating and weakening in credit. Gradually, countries are bringing gold back to their countries, increasing their gold reserves to support their own currency. Globally, everyone is accumulating gold, from ordinary people, individual investors, to large investment organizations. They are all rushing to buy gold, pushing its price to a record high. The gold pricing rule has changed over many years, especially after major events this year, such as the collapse of Silicon Valley Bank and Credit Suisse in March, or the conflict between Israel and Palestine in October. These events have made the market increasingly unstable, making other investment assets less attractive, and gold more scarce. Previously, gold buyers were primarily older adults, but now, even young people are flocking to buy gold. According to a 2023 survey, the group aged 25 to 35 accounts for more than 70% of gold buyers. In the first half of this year, gold consumption in mainland China reached 554 tons, an increase of 16%. Meanwhile, sales of luxury items such as diamonds have sharply declined. This phenomenon reflects a change in consumer habits. In the past, many people bought luxury goods to showcase their status and honor. However, now they realize the true value of gold in preserving wealth. Gold has become the preferred choice over luxury items like diamonds. This indicates that consumers have shifted their perspective, no longer chasing big brands but seeking true value. So, what does the future hold for business opportunities, and how can entrepreneurs seize the moment to quickly accumulate wealth? In the short term, Wall Street highly values gold prices. Swiss banks predict that gold prices will continue to set new records in 2024 and 2025. Some institutions even forecast that if the nominal interest rate on US 10-year bonds drops to 3%, gold prices will surge. Although investment experts are very optimistic, history always reminds us of the following cautions. Note 1. In the long run, the profit from gold investment is not as high as from stocks. Since 1970, the average annual return of the US stock market has been around 11%, while the return on gold has been only about 4%. The S&P 500 index has demonstrated this. Note 2. If you invest in gold, you should compare it with other investment products unless you are a short-term speculator, because the price of gold is very volatile. For example, if you bought gold at a high price in 2011, it would take until 2020 just to break even. Note 3. In previous decades, gold prices soared due to oil crises and high inflation, but to profit from gold, you have to choose the right timing. In the short term, investing in gold can still have potential, but knowing when to sell is crucial. Like other investments, when gold continuously appears in headlines, it may be time to consider selling. I remember when I was young, my mother told me that when she bought gold, it was only about 30 yuan per gram, equivalent to less than $10, just 1/10 of the current price. I once asked her why she didn't use all her savings to buy gold when she was young. Seizing opportunities and timing are important factors in investing, not only with gold but also with any other type of asset. Always consider macroeconomic factors, market forecasts, and actual demand before making investment decisions. So if we did nothing, we would be millionaires now, right? But in reality, it's never that easy. No one can predict the future accurately. If at that time, you invested in real estate or stocks, your assets might have increased by 10 or even 20 times. What I want to say is, don't regret what you've missed in the past, but prepare for what may happen in the future. Currently, although many people continue to buy gold and push prices higher, there are important rules to note. There have been 4 times when gold broke records, and the 5th time is happening now. The side effects of raising interest rates are inflation and unemployment, and lowering interest rates to save the market might be the most effective strategy. With the number of people wanting to invest in gold increasing, large institutions have started holding US bonds and increasing their gold reserves, exceeding 180 tons. This reflects the weakening credit value of the dollar and a shift in public consumption attitudes. People are becoming more practical and rational, focusing more on economic efficiency. In the context of economic instability and high unemployment rates, we need to pay attention to changes in consumer attitudes. An effective strategy is to participate in online light asset training courses, with 3 steps to expand your business. This training course is completely free, and you can register via the link in the description. Some predictions suggest that the price of gold could rise to $2,500 per ounce. From 1920 to 2020, stock prices increased 179 times, while gold prices only increased 82 times. Therefore, we should look far ahead and compare average returns to make decisions. No one can predict the future accurately, but we need to view the present with a vision for the future and prepare early. This is the mindset that every investor and entrepreneur should have. If possible, would you invest in gold or other assets? Expanding your vision and breaking free from a poverty mindset will help you accurately assess future global economic fluctuations. The US dollar has increased 4.1 times, the Chinese 2 yuan and 90 fen times, and gold has also risen significantly. Buy stocks in times of prosperity, buy gold in times of turmoil, is a popular saying that clearly reflects the nature of gold during periods of economic instability. What has caused the price of gold to continue reaching new heights? What will be the future of gold prices? What truths about the global economy does the rise in gold prices reflect, and what significant changes are occurring? The following factors are driving the surge in gold prices. Note 1. The financial crisis and the COVID-19 pandemic have pushed gold prices higher. The three main contributing factors are massive money printing, continuous interest rate cuts, and sharply rising inflation. Note 2. The weakening credit value of the US dollar. This occurs when countries and individuals begin to lose faith in the dollar and turn to hoarding gold. Note 3. The continuous emergence of black swans. These unexpected events have significant impacts, causing market instability. Note 4. Changes in consumer perception. Consumers are becoming increasingly practical, prioritizing economic efficiency and real value. The era of rational consumption and seeking alternatives to big brands has quietly arrived. Investing in gold or other major assets has become a trend. The future of gold prices remains uncertain, and the profit margin from gold investment can exceed 11%. However, timing the market entry is crucial. Meanwhile, the Japanese yen has increased 3.2 times, the euro 3.3 times, and the Chinese 2 yuan and 90 fen times. If the timing is incorrect, the value of these assets may diminish. When the economy is unstable, inflation rises, and unemployment rates increase, consumers shift towards investing in gold to preserve their asset value. Therefore, considering investment in gold versus other asset types is essential. No one can predict the future accurately, but being prepared early and viewing everything with a long-term perspective is something every business investor should do. Below are 4 reasons why gold is a good asset. Reason 1. It is a good means to combat inflation or the relentless rise in the prices of goods. Every year, the prices of products increase and will continue to do so. If we observe, 1 million Vietnamese dongs 10 years ago could buy a lot of things when you went to the supermarket. But now, if you go to the supermarket with only 1 million Vietnamese dongs, you know that you can only buy very few things. Therefore, if we think carefully about inflation, it will be the greatest enemy of our money because every time the prices of goods increase, the value and purchasing power of our money decrease. So, if you are saving now and only keeping everything in the bank or in a safe, you will lose money every year due to the average annual inflation rate of 4%, while your money in the safe does not generate any interest. However, this does not mean that you should not save and only focus on investing. It is still important to have savings so that you can use them in emergencies. But if you have saved too much and have enough money for your emergency fund, it is important to invest the extra money in an investment so that it can generate profit and money can make more money. Gold is a safe and easy investment to start with. It is a good means to combat inflation. According to Statista, The average annual increase in the price of gold from 1971 to 2022 was between 7.7% and 8%. With such performance, it can be said that investing in gold is a good choice as it has the potential to outpace inflation. Reason number 2. Why is investing in gold good? Because it can hold its value during times of crisis. Yes, dear friends, we have experienced many financial crises and market instabilities, witnessing many people losing their jobs, many investments collapsing, and businesses closing down. Some people have worked for over 30 years, saving money and investing, only to see everything they built collapse in an instant. If this has happened before, it will surely happen again in the future. We don't know when the economy will continue to perform well, and the only thing we can control now is our preparation. This is why the wealthy continue to invest and trust in gold, because it is the safest investment and the only asset that holds firm during times of crisis. In fact, the price of gold remains stable even during financial crises or market downturns. For instance, during the recent pandemic, the price of gold did not drop with the market. On the contrary, its price increased by more than 40% compared to 2019. American billionaire and investor Ray Dalio is also an investor in gold. He prefers to own gold rather than hold cash because he knows its stability and long-term value. The third reason why investing in gold is good is because it serves as a good supplement to your investment portfolio. It's crucial in today's age where you have multiple sources of income, be it from your job, your business, or your investments. If you lose income from one source, you still have income from the others and won't have to worry. Adding gold to your investment portfolio is beneficial because it's a safe asset with significant potential for value appreciation over time. Unlike stocks and businesses, which can be lucrative but carry risk, gold tends to hold its value and can act as a hedge. In times of crisis, when many people lose money and struggle to recover, having gold means you have a form of insurance. Even if you face losses in other investments, gold retains its value and can be used to recover financially. Reason number 4. Why investing in gold is beneficial. Because it's easy to start. Indeed, anyone who is saving and just beginning to learn about investing can start with gold. You don't need to spend many hours understanding the complexities of investing before getting started. All you need to do is research a little, buy gold, patiently wait, and repeat the process. Some individuals allocate a portion of their income to buy gold whenever they get paid. They do this monthly or every 3 months, depending on their budget. Sometimes they buy a small amount of gold, and other times a larger quantity. They continue this habit until they accumulate a significant amount of gold. The gold they initially purchased can often be sold at a higher price. Starting to invest in gold is very straightforward. You don't need to be an expert. In this type of investment, all you need is patience and the understanding that all investments take time to yield good results. Next, there are 4 things you need to consider before investing in gold. Yes, when making a decision, especially an investment, it's best not to rush. You need to determine your goals beforehand, whether your goal is long-term or short-term investment. Knowing your goal makes it easier to identify which investment types suit you best. If your goal is long-term, investments in stocks, real estate, and gold would be suitable. If it's short-term, business ventures might be more appropriate. We all know that every investment carries risks and challenges, even though investing in gold is considered safe and easy to start. You still need to consider the 4 things I'm sharing with you right now before making your investment decision. Lesson number 1. You need to consider not buying gold when its current value is high. Yes, if you want to earn more money from your investment, you should buy when the price is low and sell when it's high. Because if you buy gold when its value is high, like the price of gold in 2020, it will be difficult to sell it at a higher price later, as we cannot predict whether its value will increase in the coming years. It's important to carefully consider the timing of your investments. Ideally, you should buy gold when the price is low and patiently wait for the right time to sell it at a higher price. Lesson 2. You need to consider preserving your gold in a safe place. When you have jewelry, gold bars, or gold coins, you need a secure storage location to prevent theft. You can rent a safe deposit box at a bank or purchase a personal safe. These are additional costs you must incur to protect your investment. Lesson 3. You should understand that investing in gold does not generate income. Unlike business activities that produce revenue or daily wages, gold is not a source of income because it is not a business, and its price does not immediately increase. Therefore, if you seek active income, you might consider selling gold. However, if your goal in investing in gold is for security, it's best to be patient and continue storing your gold safely. Lesson number 4. The most important thing to consider is to ensure that you buy gold from a reliable source. There is nothing worse than being deceived in your investment, as it's akin to throwing away money. Therefore, it's crucial to do some research before purchasing gold. Don't hastily trust sellers, especially those you only meet online. A safe way to buy genuine gold at a good price is from reputable pawn shops or jewelers. They are legitimate businesses with a reputation to uphold, employing proper procedures to authenticate gold before selling. In summary, gold is a good investment to add to your portfolio as it can hedge against inflation, is relatively easy to start with, and can be relied upon during crises. All you need is some information and long-term patience if you're considering investing in gold. Also, timing your purchase wisely, storing gold securely, and understanding that it doesn't generate operational income are crucial. Ensure that the source from which you buy gold is trustworthy. To what extent did you learn from our video today, and do you think investing in gold is a good idea to add to your other investments? Please leave your thoughts below. We hope you gained valuable insights from today's video. Don't forget to subscribe to our YouTube channel to stay updated with new videos. Thank you for watching. Summary of the book. Wishing you success.